In this week's video, we'll review the latest charts and data to help us answer the question, did this week's bank failure kick off the final leg down for stocks? We've covered this chart numerous times in recent videos, and you may remember over the past couple of weeks it looked like a retest here and then a successful retest. This is the look this week. Very similar to what happened numerous times last year. The markets and the Fed really weren't in sync in terms of messaging this week, and that's what kicked off the volatility. But the main bearish catalyst this week was the second largest bank collapse in U.S. history. This topic really wasn't even on the market's radar until the open on Thursday. And back in late December and in early January, the market's expectation was that the economy was weakening and the labor market was going to weaken, and the Fed was getting closer and closer to backing off. The new data this week that came to light did not help. Another well above expectations payroll report on Friday, March 10th, and a strong ADP report on Thursday of this week as well. We'll cover this in a little bit more detail in the next segment of the video, but some of the moves on charts in just 2 sessions was incredibly striking. This is KRE, the regional bank ETF, dropped approximately 16% from Wednesday's close here to the low here on Friday, March 10th. And all of the knowns and expectations that sparked all of the good information from roughly the time the NASDAQ bottomed in December until this report here on Friday, February 3rd, the knowns and expectations prior to February 3rd quite a bit different than walking forward from February 3rd. The much stronger than expected labor report really flipped the script. Now let's take a closer look at the impact of this story during Thursday's and Friday's session. The charts in this segment are all dated and time-stamped. This one Thursday, March 9th, right after the open at 9:31 a.m. Eastern Time. At that point, the S&P 500 was up 7 points, and I believe the high of the session was up somewhere in the order of 22 points. And you can see Thursday morning, relative to the rally off the October low marked by this pink line here, this is the anchored volume-weighted average price line. Looks like the market came back to that line last week and held in a logical area and bounced. So as we said possibly in last week's video or this week on Twitter, this almost served as a confirmation or retest of the entire rally off of the October low, and it appears to be intact Thursday morning. So let's look at this same chart, but let's zoom in a little bit, allowing us to see some of these levels. This is 4084. It's the volume baseline off of the high here, so this is the beginning of the bear market. You can see the S&P 500 did exceed that line in early February, but this is where the strong labor report came in way above expectations on February 3rd, and you can see for the most part, knowns and expectations started to shift rapidly walking forward from Friday, February 3rd. So these reference points, 39.41 all the way down to 37.83. This is 9:46 a.m. on Thursday, March 9th. This is the close on Friday, March 10th, the exact same chart. So we were way up here, sitting right around this level right here. And then the bank failure or bank trouble or the bank that needed to raise capital story started to make its way through the markets. And you can see we have what appears to be somewhat of a hot knife through butter look here. And we're taking out the 200-day moving average here, the dotted line. And we're below, we closed below on Friday, the October anchored volume weighted average price line in pink. So those are 2 pretty significant bullish reference points that at this point have been exceeded on the downside. And as we know, the longer below, the more meaningful it becomes. At this point, we've been below them for 1 trading session. Really not even 1 session, 1 close. So this larger chart is Thursday, March 9th at 9:46 a.m. up in the left-hand corner up here. Similar concepts with the NYSE Composite Index. This is 11:56 a.m. on Thursday, March 9th. You can see at that point, we're about lunchtime on Thursday, and we're still holding well above these lines that are tied to the October low here. Here's price, here's where we are. And as of Wednesday's close, the NYSE composite is holding above the orange volume-based price line tied to this peak here. So the longer you're above the orange line, the higher the probability that for the most part the bear market is over. But Thursday around lunchtime, this chart still looks pretty good. There's nothing particularly alarming here relative to the October rally. If we fast forward to the end of the week, this almost looks fake. This looks like we drew this line manually on the chart. So this is between lunchtime on Thursday and the close on Friday. You can see we're well above the purple lines here. We're well above the 200-day moving average around lunchtime on Thursday. Relative to this line, and this line, that's your hot knife through butter look. Still have some areas down here at the close that could act as possible support. You can see price in here reacted going back to last year. But regardless, this is damage to the case that the rally off of the October low is the end of the bear market. A similar situation here. When we're managing risk, this is 10:22 a.m. Eastern Time on Thursday. The S&P 500 weighted more heavily to the high beta sectors, SP high beta, in the ETF world. This looks really good. This is tied to the bear market, so when you're above the blue line, the odds say the bear market could be over. We exceed that line in January of this year, and on Thursday, this looks like a retest. We're still holding. It looks good. We're well above the line that's tied to the October low. So Thursday at 10:22 a.m., there's really no reason in terms of using this chart to say that you should be doing anything with a SP high beta position other than remaining patient. There's a big change coming between 10:22 a.m. on Thursday, March 9th, and the close here on Friday, March 10th. Again, this line looks borderline fake. This is what we look like on Thursday, 10:22 a.m., well above this dark blue line, well above this line here tied to the October low, slashed through both of them by the close on Friday. You can see here, not the end of the world that you exceed the line from the October low. The longer below it, the more relevant it becomes. This quote here relates to Silicon Valley Bank this week, how quickly things unraveled. Similar situation here, IJH mid-caps, Thursday, March 9th, 10:28 a.m. Eastern Time. This looks good. Well above the line tied to the June low of last year, well above the line tied to the October low, and looking like we've started a new bull market relative to the orange line tied to the bear market or the bull market peak here that kicked off the bear market. This looks quite a bit different than this, and this. So far, this looks like a breakout and looks like some form of a retest. If we go forward, not even 2 full trading sessions to Friday's close, fairly significant change and an abrupt change, and that can be concerning. See the abrupt change here, and eventually we fall for several weeks. That's not a prediction here, but this is a very abrupt shift. And in stark contrast to this calming look up here early on Thursday. Now, we've said that foreign stocks have been leaders off the low. This is VEA March 9th at 10:39 a.m. Eastern Time. This is the anchored volume weighted average price line tied to the high here. So this kicks off the bear market. Fast forward to the close on Friday, March 10th, in the box here. Looks a little bit better. Holding this line here. So thus far we have not gone below this red line. Well above the lines tied to the October low. This is 10:01 Eastern Time on Thursday, March 9th. This is the S&P 500. It's the equal weighted index. The standard weighted index is tech heavy. On Thursday at 10 a.m., it's green. Looks like it's coming back and holding at this very important red line. That's really the bear market demarcation line. Also has the look where it came back and tested the October line here. Looks like it passed with flying colors, broke out above the red line, above red, above teal, above. And this is Thursday at 10 a.m. Trading at 59.48. Finished quite a bit lower at 56.88 at the end of the week. That's the bad news. The good news is that means we closed above this level here, very near it, where we've held in the past. So some significant incremental damage, but we do still have some potential areas of support nearby for many positions and many major indices. Doesn't mean they're going to hold. We'll see how it plays out. So let's go back to some of the topics that we covered on Friday, February 3rd, and that was after the incredibly well above expectation payroll report on Friday, February 3rd at 517,000. And we covered this chart dated February 3rd in that video, and we went over this concept that says a lot of improvement here. This is observable evidence. We talked a lot about that the move from here to here was based on knowns and expectations about future outcomes on multiple time frames regarding all subjects. And if those knowns and expectations shifted significantly, meaning the rally was in jeopardy, that we would see potentially a hot knife through butter type look where price basically says, we don't want to be up here. We want to be down here. Now, why would we talk about that on Friday, February 3rd when the chart still looks excellent? You're well above an upward sloping 20-day with a tight cluster below. Because we have something in hand already that tells us the knowns and expectations may have already shifted a bit. And that was this payroll report. This was just a blowout number, taking a lot of the expectations about the Fed and interest rates and the economy and making everybody really rethink them. So we talked about in detail a look that we would want to avoid. This is the chart on February 3rd. And there's no question we have a lot of the hot knife through butter characteristics here in front of us as of the close on March 10th. And that's something that we just can't ignore. While we're still near the moving average cluster, the tight cluster in here, and could stay there for a while even if we fall, we're close enough to all of this where we need to see really how this shakes out. Remember, the longer below, the more relevant it becomes. But there's no way to sugarcoat this. This move from here to here is very concerning. If you just look at the chart here, Wednesday's close, we're above the 75-day moving average here, and very, very close to the 20-day moving average, and above all of these moving averages here. Now, all of that is in doubt. You can see here in the COVID move, we did get a bounce back, and then bad things happen. So let's just take it day by day. We have a very, very specific plan that we have executed to the letter of the law over the past 2 days, and we will continue to do so. Mark up this chart on March 10th a little bit to get some reference points. It's also concerning that we had exceeded this August high here. You can see price broke out above this level here. And earlier we had exceeded the high here from Q4 of last year. Well, now we're back below this level. We're back below this level. And we're below what was an upward sloping trend line. Just like the moving averages, the longer below this, the longer below this, and the longer below this upward sloping trend line, the more relevant it becomes. We'll see how it plays out. I think it's probably pretty fair to say relative to March 3rd last week and this week, once again, this topic says market participants are dealing with some new and relatively important information this week, and that's always the case. But anything related to the Fed and rates going higher is very significant. And the concern about this story here is this is tied to indirectly what the Fed is doing. And think of it this way. We have a CPI report coming next week. So let's assume hypothetically that the Fed is now breaking things, that the interest rate hikes are starting to cause problems in the economy. What happens if the CPI report next week comes in above expectations and we have some additional problems similar to this problem? That puts the Fed potentially, that's all hypothetical, in a very difficult spot. They need to tame inflation. They need to cool what is a still strong labor market. But the blunt instrument that they're using, interest rate hikes, has already started to cause some problems. We had some problems with pensions in Europe related to some of their holdings in Q4 of last year, and now we're seeing some relatively minor at this point cracks in the United States. It's late on Friday evening, so let's quickly go through some examples of damage related to this story that occurred on Thursday and Friday. This is February 23rd. This is as of the close on Thursday, March 9th. Thursday, March 9th, not a confident turn right now. After the major low in 2003 here, this indicator came down to this dotted line and really never looked back. It's even better in the early stages of the 2009 low. You can see on Thursday at the close, we're well below those levels. Simply speaks to odds. This is Wednesday's close, March 8th. We're above this line. This is Thursday's close. We've covered this a lot. We'd like to see weekly MACDs clear zero. This is Thursday, March 9th at 12:08 p.m. Eastern Time. Unbelievably, intra-week on Thursday, weekly MACD was at 9.274, starting to distance itself from a bear market look. Less than 4 trading hours later, we went from a positive 9.2 noon on Thursday to a negative 9.7 at the close on Thursday. This looks more like a failed bear market rally. You can pause your video player here. We've been oscillating back and forth. This is a tweet from March 1st. This is a tweet from March 6th. Remember, Thursday at noon, 9.2, that looks like a new bull market. And of course, we know on Thursday that the weekly chart's not in the books. But you're probably not expecting the 9.2 to finish the week at negative 25.6. This is the close on Friday. Something needs to change here. We don't know what's going to happen, but this is really not what you want to see here, nor is this up here. Back below the 200-week, below the downward sloping trend line, momentum turning down below zero. Why is that relevant? That means this is a counter trend move within the context of a downtrend. A counter trend move that occurs below zero within the context of a downtrend. If you can get above zero, it looks like a new weekly uptrend. And of course, those aren't absolutes. They speak to odds. Still hanging in there on Wednesday, not so on Thursday. Weekly cloud, never taking on anything other than a counter trend look for the NASDAQ down here. This is Thursday's close. This is XLK. Remember, we need XLK to help the NASDAQ out and the S&P 500. Thursday at 12:22. PPO, which is a lot like MACD, it just allows us to compare over longer time frames in between securities. MACD's not very good for that. Same basic concept. You want to be above zero. So PPO is above zero at 1.38 at 12:22 p.m. on Thursday. That's good. It looks like the end of a bear market above zero. The end of a bear market above zero. The end of a bear market. This is Thursday at 12:27. This is a great look. You can see here in June of 2008, we barely got above zero on a closing basis, and then we turned back down. Now remember, we said earlier in the video, we've had a lot of damage, but all is not lost. XLK at the close on Friday, March 10th, PPO still above zero. Looking vulnerable, but held zero. Down here, Thursday's close, not a good look. Friday's close, even worse. You can pause your video player. Here's a turn down look in 08, a turn down look in 02. Doesn't mean that's what's going to happen. This really isn't what we want below, black below red. Talked about this numerous times. Your leaders take on a 5 for 5 look in bear markets, but if they fail, and this looks like it may be failing, that can happen during bear market rallies. So this is concerning. If you look at this chart here, price on Thursday closes below some important levels. This is Wednesday. This is Thursday. This is Thursday. You can read the blurb, not particularly encouraging. This is the end of the week. This is not what we want to see. This is a weekly cloud. Looks good here. Now it looks like a failed breakout. The good news is a lot of good check marks still here. It's not quite dead yet, still green, but far from what you really want to see, which would be a high conviction look. Wednesday's close. We're above the upward sloping trend line. Thursday, 116, we're below it. Friday, ugly. NASDAQ 100, this is January 27th. This is Thursday. This is Wednesday's close. This is Friday's close. This is the trend line. This is the 200-day. 200-day moving average for the NYSE composite. Thursday at 1:20 p.m. End of the week. Weekly, last week we held right here. Not a good look. This is Thursday the 9th. Friday we're in here. Bullish breakout, end of the week. 1,500 above everything last week, March 3rd. Hard to believe that this is 15 minutes before the close a week ago on March 3rd. This is the S&P 500 breakout. Looks like a successful retest. This is Friday's close, similar look. It means we're down here. Not a good look. Last Friday, this Friday, Thursday, Friday. This is Tuesday, this is Wednesday, this is Friday. Weekly cloud, near the weekly pivot. Cloud acting as resistance. Daily cloud was lost as of the close on Thursday. This is last week Friday. We're holding at the drawdown areas. Back into them this week and then close below this band. The slopes. That's the 30-week and the 40-week. Far from what we want to see. 130-minute cloud. Thursday's close. There's still some hope here. This is Friday. Looks a lot worse. Doesn't mean we're dead. Really don't want to be in here, but we're still in an area that could act as support. Here's the daily cloud for the S&P 500 a week ago on March 3rd, holding right at the cloud. Last week, making a stand at an upward sloping 20-week. This is March 3rd. Last week, March 3rd. Very, very good look and constructive look in here. Fast forward to the close this week. This was last week. This is this week. This is the angle off of the October low. This is the close on Friday. This is a manually drawn trend line, so it comes with caveats. This is the look a week ago. Now we're down here. A lot of program trading, commodity trading advisors are tied to levels, moving averages. Bottom line, above this level, and this level on the S&P 500, that's constructive. We were above all three earlier this week. We were even above all three at Thursday's high. When we get below them, it can bring in substantial selling pressure, somewhat of a cascade effect. 40-week, March 3rd, right here, very constructive. 40-week, a week later, looks like it's rolling over. 30-week, March 10th, really not what we're looking for. This is Thursday's close. This is price. This is the VIX on Thursday. This is the VIX on Friday above the 50 and the 200. Last week we're above all this. Thursday it's starting to look worse. Friday looks even worse. Not a good look here. This is self-explanatory. You can pause your video player. This is a great look on February 3rd, telling us things are changing. This is the look late in Friday's session. Much more concerning for risk assets. A big shift. Apple thus far, Thursday, March 9th, acting as resistance weekly cloud. ACWX mentioned this on Twitter during Thursday or Friday session. I believe it was Friday's. We closed below this level. It's not the end of the world, but it's a pretty important level. This is a leader with the cloud getting shaky. This is a week ago. It looks like a retest and a bounce. This is very constructive. This is Thursday, and this is Friday. We close back in the cloud. Not a disaster, but it doesn't look like a high conviction breakout. A lot of information here, and it's not particularly constructive. High yield Wednesday up here. Thursday's close. This is the cloud as of Thursday's close. This would be the negative. The positive is telling us to keep an open mind. This cloud is now green, telling us we could be getting closer. Maybe this is a base building situation. This is a big move. This is Thursday's close at 252. This is Friday's close down here. There's a lot going on here. You can pause your video player. This is March 10th. This is March 9th, the big chart. This is March 10th. Not a particularly encouraging look here. High yield divided by 3 to 7 year treasuries. Not a good look here. However, the cloud is saying keep an open mind about things improving in the coming weeks or months. Blue below red early 2022. Blue below red. All things being equal, rejected at the cloud, not a good thing. Netflix. Held on Thursday, below on Friday. Longer below, more relevant it becomes. This is Wednesday's close right here, the black bar. This is Thursday's close. That's a pretty big shift in one session. This is February 16th. This looks excellent above this level here. This is the end of this week. This is the 30-week moving average. Momentum. Look at the chart on February 23rd. We're right up here, so we're in this level right up here. This is the end of this week. There's a more constructive look on February 16th, right here, the exact same chart, the end of this week. You can look at risk off and risk on periods here. This is risk off, this is risk off, this is risk on, this is risk on. This is Friday. Climbing back above the intersection of this and this. This is a week ago. It looks like we're coming back up and rejected on March 3rd. This is Thursday's close. We're still below this downward sloping line and below this line. However, this is Friday's close, and this is concerning. The longer above, the more relevant it becomes. Not a particularly encouraging ratio, biotech divided by the S&P 500. XLF, weekly cloud, not a good look. This is worth reading to understand what went on this week. Regional bank ETF normally trades about 8 million shares a day. On Friday, down over 4% on roughly 97 million shares. In this environment, a fair question is, why are things changing so rapidly? Why do we go from 3 weeks of bullish activity to 3 weeks of bearish activity? Why do we have 1 week where all the charts are improving and the next week it seems like everything is deteriorating? It really boils down to the stability of interest rates. When interest rates are stable, a lot of things on Wall Street are stable. When the Fed is flip-flopping every week and interest rate volatility is high, that impacts numerous equations on Wall Street. When rates are rising, it has a binary effect relative to when rates are falling. It just happens to be the environment that we're in right now, and we don't control the environment. Can't control the frequent flips in market sentiment, but we can control our actions, our emotions, and our behaviors. The reality is this is a difficult environment for everyone. Been doing this a long time, and in the end, grit, scratching and clawing, keep working, doing it with sound methods, and always look to improve your methods. Eventually, this, and this will pay off. Another thing to keep in mind, the videos speak to the incremental changes. So this week, we're talking a lot about things that don't look good, because that's the new information that we have this week. The model on our allocations are based on probabilities related to the odds of good things happening relative to the odds of bad things happening. In this week's video, we cover a lot of things that look bad. Why? Because that was the incremental change this week. The odds deteriorated. That doesn't mean nothing in terms of the evidence and the environment has anything that's positive. It's the incremental change this week was negative. That's the new information. Probability of good things happening is never zero, and the probability of bad things happening is never zero. Clearly, we're in a position where the odds today are not as favorable as they were in early February before the very hot and unexpected non-farm payroll report. This, and this are still issues, which means more flips are possible. In terms of the bank failure and systemic fears, it's possible this week was a short-term overreaction. It's also possible this week's bank failure was the first of many dominoes to fall. We'll just have to see how it plays out. It's not a good sign when you've come out of a bear market when weekly momentum starts to turn down near zero. Something we have to monitor closely. Nothing says momentum can't improve, but right now it's turning down near zero. We added a significant amount of our allocation to the position-traded money market on Friday, and we'll continue to do so if that's what makes sense. It's a simple opportunity cost analysis at this point. The money market can offset any positions we have that are risk-related, and if the risk-related positions need to be reduced, and they need to be reduced significantly further based on the data, that's what's going to happen. The market will make that call. If weekly momentum is turning down, and we have another ugly leg down, and the last leg can be the ugliest and the most violent, it might be a good thing in the long run. It could put us in a much better spot relative to the other side. Is it possible that all of the deterioration that we talked about this week could be reversed next week? Absolutely, positively, yes. If CPI came in much, much lower than expected, then everything could flip again. It's also true, if CPI is unfavorable, that could usher in that violent next leg down. Thus, we all know, the only way any of this can work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.